Welcome to Bullshift the podcast, the weekly podcast where we talk about behavioral finance from the perspective of how the financial services industry shifts your attention to make you feel more bullish. My name is John DeGuy. I'm the host of the podcast and the author of the book, Bullshift. My guest this week is Harry Mamaysky. He is the Chief Investment Officer and Head of Research at QuantStreet Capital, as well as a professor at Columbia Business School. He holds a PhD in finance from MIT, and he has decades of experience as an investor at some of the world's largest financial institutions, including Citigroup and Morgan Stanley. He's in the world of finance and academia, which is, again, the Columbia Business School where he teaches. He's also done some work at the Yale School of Management. And his work has also been featured in a number of leading academic journals, including the Journal of Finance, the Journal of Financial Economics, and the Review of Financial Studies. So he's a smart guy. Harry, welcome.
Great to be here. Thanks, John.
I'm wondering if you could begin by explaining what you do wearing both hats. Maybe a little bit about your work as a prof at Columbia, and then maybe a little more detail in terms of your research and work at QuantStreet.
Sure, that's a great question. So, I've always been of the mind that when we teach business school students, it's great to have one foot in both doors, so to speak. On the one hand, we need to understand the theories of finance and economics that we teach to our students. On the other hand, I think we also need to understand how these tools are used in the real world. So at Columbia, I teach in our MBA program and our master's program, which is separate from the MBA, in our PhD program. I teach courses like capital markets and investments and asset pricing, which is a PhD level course. My research at Columbia looks a lot at how markets respond to information. The way that markets respond to information is often by investors looking at what are called non-traditional data sources, so things like news and earnings calls, as opposed to just looking at numbers, and using new techniques from natural language processing. Everyone has now heard of the large language models that are out there, like ChatGPT and Bard. We try to extract information from text data, like earnings calls and news, and try to understand how markets respond to that information. So that's what I do at Columbia. I teach, I do some administrative work, I do research. At QuantStreet, which is a company that I started with my brother about 3 years ago. Our idea was, why don't we take some of these tools that people use in academia and in industry at the level of institutions and make them available to just individual investors so people can invest in an intelligent, data driven way as opposed to just from gut feel, which we don't think is exactly the right way for most people to invest. So that's what I do in my two different jobs.
And in marrying those two, I'm wondering if you could weigh in on EMH, the efficient markets hypothesis. Are you the sort of person who teaches or espouses weak, semi-strong, or strong versions in particular, or what's your take on that?
Sure. So that's a great question. So yes, we do teach to our students various forms of efficient market hypothesis. I mean, if you go back to when that those ideas were invented by Eugene Fama at the University of Chicago, it was actually a revolution in how people thought about markets. Because until then, people thought that the market was like any other field of enterprise, that you work longer hours, you put in more effort, and you're going to get better outcomes, which is the way it works in most other professions. And weirdly, for year after year after year, like, that wasn't how it would work out. You would have these very smart, very diligent asset managers who would run their mutual funds, and at the end of the day, none of those mutual funds did better than the overall market. And it was really a puzzle, like, how come you have all these smart people and they're working really hard at what they do, and yet somehow, like, it's not, turning into our performance relative to just a passive market benchmark. And so when the efficient market hypothesis came out as an idea, it was really a revolution in thinking, because it said, listen, let's think about the equilibrium outcome of this process where a lot of really smart individuals are trying to gain information and outdo each other investing in markets. What are markets going to look like if that's the underlying process? And what people figured out was that, well, look, if everyone is smart and everyone is getting all this information that exists and trying to trade on it, prices in markets are going to be really, really efficient. because anytime anyone has an idea, anyone has an insight, anytime anyone has an insight, they're going to trade on it, they're going to push prices in the direction of that insight, and ultimately prices will reflect all available information to all these smart people through the market equilibrium process, through the process of people trading and trying to exploit inefficiencies. And and that idea was incredibly influential and remains incredibly influential, and we teach it to our students, obviously. But over the years, people began to understand that it's not really the entire picture. It's a pretty good description of mostly what goes on, but it's not a complete description of what goes on. And one of the really revolutionary papers that pushed us along the path of understanding the limitations of efficient markets was a paper by Grossman and Stiglitz, which was titled "On the Impossibility of Informational Efficiency in Markets." And I probably messed up the title a little bit, but something about markets cannot be fully efficient. And their revolutionary insight of Grossman and Stiglitz was that if it's costly to get information, if it's not free, if you and I wanted to trade with each other, we couldn't just costlessly obtain huge amounts of information about Tesla and Microsoft. We would have to spend hours and hours of work. And the hours and hours we spent on this could be spent doing other things. We could work in other professions and make a living. So if we're spending hours and hours of time studying financial markets, it must be because there's some kind of inefficiency that allows us to make a living doing this. And what this more subtle understanding of efficient markets taught us was that markets will be efficient to a point, but they will be efficient exactly to the point where there is just enough crumbs left on the table for the people who learn information about markets to be able to exploit that information enough to keep them in business. When too many of them come in, they're going to drive profits at the mutual fund, at the hedge fund industry down to where it's not economically sustainable to have that many funds. Funds will go out of business. The pendulum then swings in the other direction. At that point, opportunities pop up, new funds enter, say, oh, wow, now we can trade profitably. They do it for a few years, and the pendulum swings in the other direction. And so ultimately, where the pendulum settles is where markets are just inefficient enough to keep people in business, to give them incentive to get information. But the fact that people spend the effort and get the information makes markets pretty darn efficient, but not 100% efficient. So
Right.
that's
So that
the more
yeah,
subtle thing we try to explain to our students.
great. And from there, I think it's a good segue to what you do at QuantStreet. I'm wondering if you could maybe take a moment. 'Cause I know that you say that what the work you do as a firm, it builds customized portfolios, it builds model portfolio deliveries, does some personalized financial planning. Maybe you could take a moment to explain what QuantStreet does and maybe the niche that it fills.
Sure. So thanks. That's a great question. If you look at how the asset management industry is structured, there is an enormous amount of resources and effort poured into very specialized investment vehicles. So, for example, if you wanted to get an investment grade corporate bond fund, there are many options of very smart people managing investment grade corporate bond. If you wanted to go to EM, non-dollar denominated debt, you have those funds. If you wanted a fund that focuses on, the technology sector or the biotech sector, like each of those areas has a lot of effort, a lot of people devoted to looking for opportunities in those sectors. So that's what we would call micro efficiency. Like that's markets being really good at absorbing security level information. Like is this corporate bond correctly priced? Is this stock correctly priced? Is Microsoft correctly priced relative to Amazon? The market is really good at making those kinds of determinations. But then when you take a step back and you ask yourself, is that the problem that most individuals are trying to solve? Or even is that the problem that most institutions are trying to solve? And what you conclude is that really that's not what most individuals are trying to do. Like when before we started Quant Street, when I would invest my own money and advise my family and friends on how to invest, I really never told them you should pick this stock over that stock because I don't feel I had any insight into that. I would tell them, look, maybe corporate bond as an asset class looks attractive. Maybe U.S. stocks look more attractive relative to international stocks. Maybe 30-year Treasury bonds look attractive and 10-year Treasury bonds look less attractive. So the problem that most people are trying to solve is figure out what is my risk tolerance, how much risk am I willing to bear, and then given my risk tolerance, how do I optimally structure my investments across the broad array of available asset classes. Individuals, by and large, are not interested in should I pick Amazon versus Tesla versus Microsoft. They're more interested in how much stocks should I have, how much bonds should I have within stocks. Should I be US or international EM within bonds? Should I do corporate treasuries, international investment grade, international non-dollar denominated EM, et cetera? These are the things people are trying to solve for. And when you look at the resources provided to these individuals, it turns out that the investment management industry has actually devoted fewer resources to this asset allocation problem relative to the resources they've devoted to all the other aspects of this micro efficiency of let's get a great technology fund, let's get a great high yield bond fund, let's get a great EM fund. Those are very well covered. But is there someone who can really advise people broadly on how do I do good asset allocation? We thought that was where the opportunity was for us at QuantStreet. There are people who do this. Of course, there are endowments and pension funds, and famously, the Yale Endowment has done a great job of managing their resources over the decades. But those sort of strategies are not broadly available to individuals.
Right.
What is available to individuals are things like target date funds. So if you're going to retire in 2065, there's a target date fund offered by Fidelity, Vanguard, PIMCO, Schwab, BlackRock, TIAA, Kraft that'll get you to that kind of stock bond mix. But by and large, those funds are passive. And what I mean by that is when treasury yields a few years ago were at 0.5%, so the 10-year treasury hit 0.5% in the COVID year 2020, they had about the same allocation to treasuries as they had when a month and a half ago, 10-year treasury yields were close to 5%.
Right.
So am I saying that markets are totally forecastable? Not at all. You can't forecast markets with the kind of precision that you can forecast the weather. But is there little pockets of predictability here and there? Can we say that when treasury yields go from 0.5% to 5%, treasuries are just slightly more attractive than they were 4.5% ago? Can we say that when high yield sells off and is trading at a yield of 15%, as opposed to a yield of 6%, at 15%, it's just a little bit more attractive? Can we make those
We
kinds of
don't know.
statements? Our feeling in QuantStreet is yes, we can. And that's what we try to do. We try to do tactical asset allocation that takes advantage of the little bits of predictability that there are in markets. Not that there's a lot of predictability, but a little bit of predictability across some asset classes. And we offer that service to individuals, importantly tailored to their risk preferences. And we think we're a unique offering because a lot of the other offerings here are very static. They don't respond to these kind of dynamic opportunities in markets. Some do, but by and large, a lot of folks do not do that. We do that. We think we have a good methodology for doing that, and we think that it helps our clients better invest their and their families' money.
It sounds like it's a modified Gary Brinson. If you think of the work that was done by Brinson, Hood, and Biebauer 25, 30, 35 years ago about the primacy of strategic asset allocation, it sounds like there's a strategic asset allocation with a tactical overlay based on valuations and macro circumstances, which is on the margin, hopefully going to lead to a better outcome. So that's helpful. It's intriguing. I'm wondering if you could weigh in on AI. I know that you've got some background in artificial intelligence, and specifically, it sounds like if we're going to tweak what otherwise would have been a relatively static asset allocation in order to take advantage of relative mispricings based on market moves and current events, uh, does artificial intelligence do a better job of finding them, but also b implementing those tweaks to hopefully lead to better risk adjusted returns?
So that's a great question. I mean, the short answer to the question is no. AI cannot beat people at the job of investing, and I wouldn't even let it try, frankly, because it has many flaws. But the way I would say it is an investor who capably uses AI in her or his investment process is going to do better than the investor who doesn't use AI. So I think that's where we are in the stage of market evolution. Like, I don't think the machines can trade or invest on their own because there's a lot of pitfalls. Like, we use machine learning, we use AI methodologies, and very often the machines left to their own devices do what I consider really crazy things. On the other hand, here's a problem that you and I can't solve as individuals. Let's say that we wanted to listen to all, the fourth quarter earnings calls as they begin to happen, and understand how is every company that's reporting in the US, I don't know, 3,000 companies or so, what are they saying about their uses of AI? Are they using it on the client acquisition side? Are they using it in terms of improving their, production processes? Are they using it to improve their engineering processes? How are they using it? Frankly, you and I could not answer this question because there's 3,000 earnings calls. Each of them is an hour and a half. That's 4,500 hours, right? A typical working year is 2,000 hours. So it would take you and me, if we work together, probably a full year or more and if that's all we did, to digest just the earnings calls that come out in one quarter. So we can't reasonably process that amount of information. That's not to say that there isn't incredibly valuable information in all of the things that companies are telling us about their business, not just about AI, but about their supply chains and what they're seeing in terms of the customer demographics. Like, there's enormous information there. And machines are really good at extracting that information. So there are a lot of companies now that are doing this. They're applying these, large language models, these neural network models, but they're asking them pretty simple questions. They're saying, okay, take this earnings call and find for me every time the management talks about the regulatory environment, for example. Like, is the company seeing higher regulation from whoever regulates them, or are they seeing lower? Are they being deregulated? And you can begin to answer those questions broadly about the entire economy. So you can see, is regulation increasing or decreasing? Is AI adoption increasing or decreasing? Is anyone still talking about Bitcoin? What are people saying about supply chains? What are people saying about their China business? What are people saying about their business in India? That kind of information can be extracted using these algorithms in a way that humans really have no ability to extract information. Now, what do you do with information? Well, if you then say, okay, machine, you extracted information, you go and trade, it'll be a disaster. You're gonna blow up your portfolios, and your investors are gonna lose money, be very unhappy. But if you massage that information in an appropriate way for humans to understand, if you give humans the right sort of dashboard, they will be able to have a much richer information set, and they'll be able to make much better decisions for how to invest on behalf of their customers and clients, than they would without this technology. So, what the technology can allow us to do is to make markets yet more efficient. It's like an arms race, like get more information into prices. But more importantly, what is the underlying role of a capitalist market system? Is to funnel capital into its most productive uses in the economy, and to take capital away from uses where it's stagnating. And using these tools, we can increase the productivity of the economy overall, because capital markets funnel capital to its best uses, and we can understand how to do that better. So, we are where the chess world was, I don't know, 30 years ago, where the chess AI cannot beat the best human, but a human using that machine can beat the best human. That's where we are with investing. At this point, of course, the machines can beat humans in chess,
Right.
far without any doubt. But that took years to get there. I'm not sure we'll ever get there with investing, because it's a different thing than chess, much less
Right.
deterministic and a lot more uncertainty. But for sure, today humans using AI can beat humans who don't use AI in making better financial decisions, and that's how I think these tools are being used.
When it comes to decision making, a lot of decision making revolves around your expectations going into what what the future might hold. So as we are now taping this at the end of 2023, different people have different expectations with regard to what might be in store. And lots of houses are putting out their forecasts about what they expect the S&P 500 to do in 2024, and so forth. Do you have any thoughts on, and I guess you could answer this two ways. I'm curious about your clients at QuantStreet, but I'm also interested in what the views of your students at Columbia think. Would you say that investors slash students are more optimistic about the future these days, or less, or about the same? And if they're different in either direction, why is that?
That's a good question. I don't have a good sense, because it's too spotty of what our students think about the investing climate. I I've talked to some people who are fairly sanguine. I've talked to other people who are less sanguine. I don't know what the average view is because I haven't done a very careful sample. It certainly feels to me like the bearishness we saw last year, where everyone was forecasting the world was ending when the market had a drawdown of 25%, is much less prevalent today. I think people are a little bit more sanguine. I think people are anticipating that the Fed and other global central banks will begin to ease monetary policy for the Fed, likely starting in May of 2024 or so. In our work at QuantStreet, we have found that when the Fed begins to ease monetary policy, the subsequent 2 year period has typically been a good period for financial markets, where financial markets return somewhere in the range of 20 to 30% over that 2 year period. Now, that average hides an enormous amount of variation. Sometimes the Fed begins to ease and the market absolutely tanks because the Fed is easing in anticipation of bad things happening in the economy. Um, I my sense is that that's not the case now. I think that the Fed is going to begin to ease policy, and it'll be associated with a fairly benign environment for markets. I also acknowledge that valuations are pretty high in some sectors, especially in technology. But what I would argue is that the models that give us back a valuation metric for things like Nasdaq and other parts of the stock market are not aware of the revolution that's been happening in AI that we've been discussing. And I'm a big believer. I think that these technologies are really going to revolutionize not only how we invest, but how our society conducts business and how we conduct research. It'll have huge impacts on medicine and on transportation and sort of energy production and all aspects of our economic life. So I'm a big believer, and I think when the models say, "Look, this looks expensive," the models don't have a variable in it saying that we are undergoing a once in a generation type of technological transformation. So, admittedly, I'm painting a somewhat Pollyannish picture of the world, but I think between the Fed cutting rates and between the impact of these technologies, which I really buy into, we have a fairly good backdrop for risk assets in the year ahead. And I would just give one more caveat. These forecasts are about as good as a coin flip. So if
Okay.
what I told you, if it has a 51% chance of being right and a 49% chance of being wrong, I'm doing pretty well because 51-49 is about as good as it's going to get in this business. So, take everything I said with a grain of salt, but that's how it feels to me.
Can I find it? Let me see if I can find a way to give a maybe a little more tangible example. I presume that you're familiar with Robert Schiller's work with the CAPE ratio, the cyclical adjusted
Sure,
price earnings ratio. So the
absolutely.
CAPE ratio for the S&P 500 right now, depending on where you look, is somewhere north of 30. Not a lot, but the most conservative numbers put it at around 29. The most aggressive ones put it at 33 or 34. Um, let's say 35 is a number where the signs start flashing red, and people start saying this is now an unambiguously expensive market. Between the work you do with the subtle tweaks on the margin with regard to the asset mix and the use of AI, is that an example, or if not, what would be an example of when the people at Quant Street would say, well, based on this, maybe we should lighten up on our U.S. equity exposure, for instance.
Okay, so that's such a great question. I've many responses to it. First response. The CAPE ratio, the cyclically adjusted price earnings ratio, has exhibited an upward trend for the last several decades. And the reason is, um, one reason, there are multiple reasons. One reason is that so much of our economy is now in the technology sector. And when companies conduct R&D, they don't capitalize R&D. R&D counts as an expense. So 40 years ago, when companies would invest, would do capex investing, that did not hit their earnings. It showed up as book value of equity because that's how the accounting treatment works. When companies like Microsoft and Google, and Nvidia invest billions and billions and billions of dollars in R&D, it doesn't actually show up anywhere in their balance sheet unless they do an acquisition and it shows up as goodwill, but it doesn't really show up. So it counts as an expense against their earnings. So one thing I would ask is, are earnings that you see from Nvidia with their massive technological investment today really comparable to the earnings we saw from US Steel, to pick a company that's in the news nowadays, from 40 years ago, where when they would build a new, manufacturing plant, it didn't count as an expense. It just counted as capex. So that's one point. I'm not sure cyclically adjusted price earnings ratios today are comparable to what they were 30 years ago. So that's point number one. Point number two is the way our forecasting models work is we throw in a lot of forecasting variables to a machine learning algorithm. It selects the variables that are useful for forecasting a given asset class. And those variables are different across different asset classes. And it makes a forecast for that asset class. And each asset class essentially gets its own model, even though the process is the same. Admittedly, the forecasting model finds variables that look like CAPE. In fact, a variable that we use is the inverse of CAPE. We use the earnings to price ratio minus the 10-year yield as one variable. And the model finds that variable, and it finds that that variable is an important forecaster of future stock returns. And furthermore, that based on that variable, stocks don't look that attractive right now. That's the sense in which I'm saying that the model is missing the ingredient of once in a multi-decade revolution in technology. Our model doesn't know that that's happening. So I take what the model says with a little bit of a grain of salt. And the third answer to your question is the way we structure our investing is with a lot of, I would say, humility. We get our clients risk tolerant. So we get a client who may tell us, look, I'd like a portfolio that has the same risk level as 60% stock, 40% bond. We have another client who says, I want a portfolio that's 85% stock, 15% bond kind of risk. We understand, at least I understand, and I think broadly we in the investment industry understand that our forecasts are about as good as a coin flip. 51-49 is pretty good. So it would really take a lot of like chutzpah to say that, okay, based on my 51-49 forecast, I'm going to take a client who's comfortable with 60-40 risk and increase their risk to 90-10. Or we're going to take a 60-40 risk client and take them down to like 20-80 risk. We are allowed at the margin to shade the risk allocation of given clients. If they're 60-40, maybe we go to like 52-48, maybe we go to like 68-32. Like we make those shifts a little bit, but by and large, we try to keep each portfolio at the risk level that clients are comfortable with. Now, within that, we certainly take the asset allocation part seriously. So we might say, look, US stocks look more attractive than international stocks. Within US, we might say NASDAQ looks more or less attractive than utilities, and that looks more or less attractive than the financial sector. So we do those kinds of shifts within asset classes, but we try not to make very big shifts between that 60-40 mix of saying now we should go all into cash, things like that, because we just don't believe that our forecast is accurate enough to overrule our client's stated risk preference, which is what we really try to respect in our.
Okay, good. All right, I think we're running out of time, so I want to wrap this up with the way we always like to end things up on Bullshift the podcast with two things. The first is that's bullshit. If there was anything in your mind, Harry, that you think the industry could be doing better, differently, but specifically better, what would that be?
So I've spent now about 3 years in the investment advisory business, in addition to what I do at Columbia. My sense has been that there are a lot of great investment advisors out there, and there are a lot of not so great investment advisors out there. And when individuals interact with investment advisors, they really don't have a good way of understanding, am I talking to someone who's very good, or am I talking to someone who's not very good? I think the industry can do a better job of guiding clients to understand the quality of the product that is being offered. I don't know how to do that. It's challenging, but it would certainly be nice when a client contacts an investment advisor for the client to have some sense of, is this person really good at what they do or not? Like it's the same problem when you hire a lawyer. It's the same problem when you hire a doctor. But one thing to point out is the amount of accreditation that investment advisors need is less than doctors and lawyers need. And maybe what we need is a little bit more formal training or something along those lines, which will set the bar a little bit higher. So I think if I could make a critique about a subset of this industry, I would say we can raise the bar a bit on the kind of financial advice that folks are getting. Even though some people get great financial advice, I think some people aren't getting great financial advice. And I think that bar could be raised and it would be beneficial to a lot of our
Which,
clients.
which then brings us to shift happens. Now, you've already said that. So shift happens is where I say, okay, Harry, you have identified the problem. We need to get a higher standard of advice in general. What would you do to solve it? Now, you already said that you didn't have an idea, so let me put one out there. What if we made it mandatory for all financial advisors to be fiduciaries, the way doctors have to take a Hippocratic oath? What if there was an obligation, a legally binding obligation for financial advisors to make recommendations that were in the client's best interest, as opposed to, and now I'm speaking in the Canadian market. In Canada, if you're not a portfolio manager, you are only held to the interest of making recommendations that are suitable. Only portfolio managers have to make recommendations in the client's best interest. And
I
only
see.
about 3% of all advisors in Canada are portfolio managers. What if we were to find a way to make the other 97% uh, forced to get them to act as fiduciaries the way they are in other jurisdictions and the way they are in other professions? That would help.
I think it'd help a lot. I mean, look, in the US, I can't speak about Canada, but in the US, there are two models here. There's the broker dealer model, which does not have a fiduciary responsibility. And then there's the RIA, the registered investment advisor model, which is what we are at QuantStreet, where you have a fiduciary duty to clients. And I think that makes a world of difference because, we are supposed to give clients advice that's good for them. As a broker dealer, you don't have that level of responsibility. You can basically just facilitate your clients' transactions. If they ask you to do some crazy thing, you can say, okay, you asked me to do it, I'll do it, and whatever. As an investment advisor, you're not allowed to do that. You're not allowed to take, an 80-year-old retired couple who wants to put all their money into Bitcoin and say, yeah, I'm glad to do that for you. You're supposed to tell them, no, I don't think that's appropriate. And if they won't listen, you're just not supposed to work with them, frankly, because that would be bad for them. So I don't know the Canadian system. In the US, the entire investment advisory industry is based on the fiduciary principle. And I think that is the right way for the industry to be structured.
Great. That's a great way to end. Harry, I want to thank you so much for your time, your insights. It's been wonderful. I've really enjoyed chatting with you. All the best to you, sir.
All right, great. Thank you for having me on.
John DeGooey is a portfolio manager in Toronto and the author of the book Bullshift: How Optimism Bias Threatens Your Finances. Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.